7 years on from the great financial crisis of 2008, and all is not well in the world economy. Growth, having collapsed in the developed world, is now slowing in the emerging market economies, the poorer nations that make up 60% of the global economy. China's wobble earlier this year prompted stock market panics across the rest of the world, as this article in The Guardian reports. The world's second largest economy seems set to follow the path of the US, the UK and others. The world's debt pile has grown at an extraordinary pace, with $52 trillion added since the crash, taking the world's total debt to over $199 trillion globally. The wealth of the wealthiest continues to rise into the stratosphere, with just 1% of the world's population owning more than half the world's wealth, as Fortune magazine reports. And as the Paris climate talks reminded us, there are ominous signs that humanity's collective disregard for its environmental impacts is pushing the world closer to climate catastrophe. This wasn't, needless to say, entirely in the script. The crisis of 2008 was a nasty shock, certainly, but by early 2009 it could be reasonably argued that the advanced economies hardest hit by the crash, notably the US and the UK, had got themselves on top of things. Capitalism, far from facing an existential crisis, as perhaps some hoped and some feared, could be dusted off and set back on the road. And yet nothing seems to quite work as it should. It's impossible to read the financial press without picking up the sense of fundamental unease. Martin Wolf, star columnist at the Financial Times, previously a devoted enthusiast for the cause of globalisation, has become a withering critic of the current global setup. From the failures of the Eurozone to the sheer listlessness of the authorities charged with overseeing the world economy, Wolf has provided a forensic dissection of capitalism's current woes. More recently, he has covered a disturbing trend revealed in his article, Corporate Surpluses Are Contributing to the Savings Glut. Whilst companies in the developed world are raking in profits, as a share of the economic pie, UK company profits have never been bigger, they are failing to invest. This means that Apple, for example, now has more money in its bank account than has the US government, as the BBC reports. Much more, 3 times as much, on one estimate, as tech publication The Register shows. But this is critical. The secret of capitalism's success, over the last 200 or more years it's been around, is in continually delivering more and more investment. That's how it's supposed to work. You invest, you make profits, you invest some more, and so on. So if this dynamic breaks down, the consequences are huge. The one claim capitalism can undoubtedly make about itself, that it delivers investment and therefore growth, no longer applies. The prospect of a permanently slower and weaker capitalism is provoking much debate amongst the mainstream of discussion in economics. Lawrence Summers, former US Treasury Secretary under Bill Clinton, has resurrected an old idea in economic theory. Summers has claimed that what we're experiencing now is secular stagnation, as shown in his article for the Washington Post, where he outlines his strategies for sustainable growth. Now, by secular stagnation, he means not only that the global economy had a shock in 2008, it's that the shock of 2008 opened up a period of fundamentally low growth and weak investment. Summers argues that it is only a series of financial bubbles over the last few decades that have driven capitalism along. And now we've run out of bubbles to inflate, leaving governments and traditional economic policy powerless to respond. Governments, instead, must intervene, spending directly in the economy to keep the show on the road. Reporting in The Guardian, Heather Stewart writes that wealthy countries must bolster public spending to avoid global slump, and that the UN's development arm, the UN Conference on Trade and Development, broadly shares Lawrence Summers' view. Quite opposite to the austerity, spending cuts, that governments across Europe have embraced, the UN agency thinks that rich countries must boost public spending and kickstart growth. With private capitalism unable to produce investment and growth, and with interest rates jammed at near zero levels, it is up to direct government spending to keep capitalism moving. The prescription is a return to a kind of old-fashioned Keynesianism. Writing in the depths of the 1930s Great Depression, Keynes argued that without government spending, capitalist economies could find themselves trapped permanently in a slump. Private capitalism would be stuck in a vicious circle of weak demand, low incomes and high unemployment. In Paul Krugman's article, The Austerity Delusion for The Guardian, he quotes Keynes from 1937. "The boom, not the slump, is the right time for austerity at the Treasury." So those who support secular stagnation tend also to support a return to some of Keynes's core ideas. The issue is controversial. Former US Federal Reserve Governor Ben Bernanke strongly disagrees, arguing instead in a recent blog post for the Brookings Institution that there is a global savings glut, caused principally by governments encouraging an excessive level of savings. He argues that first China and now Germany were simply saving too much. With too many savings, chasing too few opportunities to invest, interest rates collapse and massive imbalances appear in the world economy. China before the crash and Germany after the crash have failed to buy enough from places like, for example, the US, to prevent the world economy from slowing down. The rise of China is a decisive factor in the development of the world economy. The creation by China of new international institutions, most notably the Asian Infrastructure Investment Bank, has been highlighted by Lawrence Summers as the moment the United States lost its role as the underwriter of the global economic system. He writes in the FT that it's time the US leadership woke up to a new economic era. Beneath the arguments about secular stagnation in the West is a still deeper argument about how, and for whose benefit, the new global economy will be shaped. The stock market crash in China, sparking further share price routes across the world, illustrated just how central this economy now is, and perhaps how far we are from seeing a resolution to the troubled period the years since 2008 have opened up. Writing in the Financial Times, Peter Oppenheimer, chief global equity strategist at Goldman Sachs no less, has described the three waves of crisis that have erupted since then, saying that the emerging market slowdown is the third and last wave of the crisis. The first was the Anglo-American crash of 2008 itself. He writes that phase one was the US wave that started with the housing market collapse, spread into a broader credit crunch, and ended with the Lehman collapse and the start of QE, quantitative easing, creating new money, which authorities in the UK, the US, and elsewhere resorted to after the extraordinarily costly bailouts of their banks. This QE stabilised the US and the UK economies. But it was short-lived, as the focus soon shifted to Europe and the second wave formed, as Peter Oppenheimer continues. As the FT article goes on to state, just as Europe appeared to emerge from its crisis, the third wave took shape in the form of collapsing commodity markets and weakening emerging markets. The future in any of these prognoses looks bleak. A permanently weakened capitalism, beset by successive crises, in which a tiny gilded elite grab all the proceeds of whatever growth remains, whilst the rest of us scrabble around for whatever marginal employment can be found as automation destroys jobs. But perhaps there is a different route. Ambrose Evans Pritchard of The Telegraph wrote an intriguing article, "The World Economy as We Know It is About to be Turned on Its Head." He highlights recent work by Charles Goodhart, former central banker at the Bank of England and now professor at the London School of Economics. Goodhart argues that the fears of secular stagnation may be misplaced. The great 30-year swing in the balance of economic power in favour of those who own wealth may now be coming to an end. What has been called neoliberalism, involving the privatisation of public assets, the unleashing of finance capital, and a profound indifference to rising inequality, was, in fact, in Goodhart's argument, the product of deep changes in the world economy. A booming global population created an immense glut of labour. Combined with the technological changes that enabled production to spread across the world and the political changes that tore down the Berlin Wall, those owning capital were able to gain a decisive advantage over those who sold their labour. The result was a relentless slide in the share of the economic pie going to labour. Real wages in the US for adult male workers per hour did not rise for 20 years between 1975 and 1995. That period is now drawing to a close, argues Professor Goodhart. As the global population ages, and as population growth slows down, there will simply be fewer workers around. And if there are fewer workers, they will need to be paid more to persuade them to work. Professor Goodhart argues that we are on the cusp of a complete reversal. Labour will be increasingly in short supply, companies have been making pots of money, but life isn't going to be so cosy for them anymore. Provocatively, Evans Pritchard adds his own codicil. The last time Europe's serfs suddenly found themselves in huge demand was after the Black Death in the mid-14th century. They say it ended feudalism. And as the modern-day serfs sense their own power, they will pull the system in their favour. They will demand higher wages, greater social spending, and a redistribution of wealth from the super-rich to the rest. Perhaps then we are on a cusp of a new peasants' revolt.